Hedge funds have been in the news this week after some high-profile criticism of their high fees and modus operandi. And the pundits have been out in full force to extol the virtues of hedge funds and protect their turf. Joining us now on the line is Pierre Verster from Fairtree Capital. Pierre, welcome. So let's start off with the high-profile criticism this week from Magda Wazirski of Sygnia. Why do you think she did it?
Hi, Lee. Look, there's been a lot of disruption in the hedge fund industry since regulation came about 2 to 3 years ago. And a lot of the hedge fund of funds have needed to change their business model. And some of them have successfully changed their business model to change their offering, while Sygnia decided to exit the hedge fund industry. So I think that had a lot to do with the type of comments and the type of language used in the column earlier in this week.
So does this mean it's the end of the road for fund of funds, hedge funds?
No, I don't think it's the end of the road, but I do think they all need to reconsider their business model, and some have. Some have moved to, for instance, portable alpha-type products and other ways of offering value for the fee that they charge. But those that did not reinvent the business model have decided to rather look at other places to put their pension fund client money, for instance, private equity, infrastructure, technology, structured products, even cryptocurrencies. And that's all within the rights of the fund of fund provider. Obviously, as investors, they just need to always make sure they know what they are investing in and the costs involved.
So will those new types of funds be subject to the same regulation as hedge funds that's come out recently in the past 2 years, the Collective Investment Scheme Act?
It would depend on the type of vehicle used for those investments, and that is why the regulations have been brought in for hedge funds, because it was such a wide variety of different strategies. It needed regulation to ensure that mandates are agreed to and that money is managed according to those mandate limits. But there are still pools of capital that are not being managed according to regulated structures and mandates. So I can't speak for any industry, whether the hedge fund industry or the hedge fund of fund industry. I can just say that the better the transparency, the better for the investor to understand what they are investing in.
But some people say, Pierre, that now that the hedge fund industry is regulated and has the eyes of the tax man on it, that hedge funds have lost their flavor.
Well, I think time will tell regarding whether hedge funds have lost their flavor. Year to date, the average equity long-short hedge fund has done better than the market and has given a positive return to June versus the market's negative return. The tax issue you refer to is actually very interesting. It was announced in the budget earlier this year that National Treasury is looking at the taxation of all collective investment schemes, whether hedge funds or traditional long-only funds. And that is an issue being dealt with at the highest level because of the negative impact that could have on the South African savings industry, and whether hedge funds and other long-only funds going forward will be managed from South Africa or will move abroad and be a net loss to the fiscus.
Yeah. Okay, but Pierre, the hedge fund industry has been declining in the past few years in South Africa. Last year, it lost 5 billion rand of assets under management, and the industry as a whole has given low performance returns. So isn't that coming into why people are getting out right now?
Yes, you refer to a very specific period, and that is the last 2 years as we've seen this transition. And the biggest source of where the money has flown out of the hedge fund industry is because of the hedge fund of funds themselves experiencing an outflow from their funds. If you look at the longer term, and that is the point I made, it's very easy to make broad statements regarding the hedge fund industry. But if you look at the 3 or 4 largest hedge funds in the country that have been the largest hedge funds over the last 4 or 5 years, you can go to their websites, you can download the monthly fact sheets, and you can see over the last 7 years, over the long term, actually even longer, you can include the 2008 crash. Hedge funds, those major hedge funds, have performed better than the all-share index even after fees. So the last 2 years was a very specific period, and people shouldn't cherry-pick on this specific period as an indication of the long-term performance of hedge funds.
Yeah, okay. Let's get on to the fee issue. Magda calling it a fee racket with an investment strategy to rake in high fees. And when you're looking at 20% on performance, that's steep.
Yes. Once again, I feel that that criticism is not quite accurate. Most hedge funds have a basic fee of 1%, which is quite competitive, and a performance fee of normally 20% that only kicks in after a cash rate, whether it's the JIBAR rate, the STEFI rate, or a money market rate, has been exceeded. And interestingly enough, over the last 3 years, a money market rate on average has been a higher hurdle than the all-share index. So it's a strange time to be complaining about that hurdle. So I think a performance fee structure is quite a fair structure, where only if the manager outperforms can the manager charge a performance fee. And if the manager does not outperform, they cannot charge a performance fee. So it's a variable fee, and it basically comes down to paying for performance, which is a fair outcome.
But it's also a whole short-term approach, because they might outperform 1 year and hence earn their fees. Next year have a bad year and the asset value of the fund goes right down. So the investor may actually feel a bit of pain, a bit of remorse.
Exactly, and that is why hedge funds have got high watermarks. So you can never double dip, you can never go into a negative period and then charge fees again to recover from that. And that is another safeguard to make sure that clients are in a fair position.
Okay, so there are some bad eggs out there in the hedge fund industry, whether they're local or international. What is your advice to investor? How do we steer clear of the bad eggs? Look at the fees?
I would say one needs to look at the performance after the fees. And there is, I would say, in any industry, above average players, and below average players. The hedge fund industry is no different to the long-only industry and even the ETF industry. For instance, in the US, you have inverse ETFs and VIX ETFs, which have given very scary returns to their investors. So, as always, buyer beware, do your homework, make sure you understand what you're investing in, and go for regulated structures where there's complete transparency according to all the fees and the performance after fees.
Yeah, wise counsel. Thank you, Jean-Pierre. That was Jean-Pierre Verster from Fairtree Capital.